Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for Monday, March 7th, 2022. Not a whole lot to report, but I do want to show where we're at and what we can might expect, what to look for this week. All right, so this is just a long-term chart of the S&P 500. I'm just going to walk it down the time frames very fast. So really nothing new here to report, especially on the long-term frames. Short-term frames, I'm going to talk a little more in depth, but we have those the solid PPO crossover that occurred in all the indexes. SPY happened first in QQQ, as I detailed a couple months ago, and then followed last month with a confirming red histogram bar, meaning that it's a confirmed bearish PPO crossover on the monthly, followed by, so far the PPO is buried deep right now. The histogram is deep, meaning the lines have solidly crossed. And again, if you're new to the site, I'll just tell you why that's important. One of many things. Every single crossover here, I have them when we had the bearish crossovers marked what that correction was associated with from high to low. For some reason, that one's not popping up there. I thought I had that in there, and that one was, you can see from the pop-up box to the left down the bottom, that was 22%, 21.69. So we round that up to 22%. And right here, and remember, again, these were bull market corrections, the 22%, that first one there. And again, that's high to low, and associated with these red when the histogram goes red, but these are your bear market ones, 57% and 51. Those are the only two bear markets we've had for decades, what I consider bear markets. Again, I call what happened during when COVID hit, even though it was a 36% drop, media will chalk it up, call it a bear market, call it what you want, but I call it Ursa interruptus, interrupted bear market, a la Fed and Washington, gunning the economy, flooding the economy, overstimulating the economy, so to speak, and causing hyperinflation. So again, what you might want to look for then, if at the bare minimum, take the average of these drops, 22, 15, 20, 36, and looking at another run back down to the primary uptrend line right there. But if we cross this line right here, this is what I'll be watching. We've got, look, it's only March 7th, so we have another 3 weeks to go. But this is a big level here, this 20 period exponential monthly average. Exponential moving average, excuse me, on the monthly time frame, and that does a great job of denoting bull and bear trends. There's 2007, we lost it back here early on in the bear market after that candlestick closed below it, and then back tested it from below and rejected, and then you had your next leg down. And the previous bear market before that, 2000 to 2002, we took it out right there on a monthly closing basis, back tested it from below for a couple months, and came in, another back test, and the bear market was over here, and then you took it back and said new bull market. So it does a great job. It's one of many I use, trend indicators, that is. QQQ, same story. So what we're looking at now, and this is why I jumped over to QQQ, last month we had a stick save, again a monthly chart. All that matters is how the candle closes, so it wasn't a whipsaw or a false signal. It was just an intra-month break with a solid monthly close back above the 20 period EMA. So far we're below it right now, so this market can giddy up again, once again, 3 weeks to do so, to close back above that level. But if we hold or build on these losses, which I suspect we will, and head down to my next target or targets, then we're going to have that sell signal. And you can see as I roll back in time here, same thing with the PPO histogram crossovers, all these red bars, 31% drop, 24% associate that one, 26. NASDAQ, you get more bang for your buck. It's a more volatile index than the S&P 500, and so far, the other day I put 22 question mark because that still goes to the recent lows, and the 2 question marks are there because I don't believe that's it. It's most likely not the end of this correction. Possible, sometimes you come in. Look, that's what happened in COVID. You had a perfect, look how well that moving average worked there. There's your monthly candle in QQQ. We had a big intra-month break only to close the month back right above it, and then the following month another brief intra-month break with a green close back above it. successful defense there. There. You can just see how well, if you just use this as your 401k guide, at least in hindsight, there's no guarantee it's going to work going forward, and we're out of the market or short the market when the QQQ was trading below here. You either profited greatly on those shorts or avoided big losses on your longs. It's not an exact timing indicator. It doesn't get you into the lows. That's why I walk my way down to the time frames, and we look at the daily, weekly, and even 60-minute charts to try to hone in, like we did today, threading the needle with that bounce this morning back into resistance is another objective short level I pointed out. So that's it. You can see just a great job. Look at that bull market. Long, be long and strong when you're above it, and be short or out of the market when you cross below it. There's the end of the, or that was the end of that bear market 02. There was your crossover. Did a great job. So, all right, I don't want to beat a dead horse. Just saying that we are solidly, at least by the histogram, the crossovers, and then this will be our next early sign or likely indication if we have a solid monthly close below here. Again, 3 weeks ago, and I want to see it. I'd like to see it at least on the S&P 500 as well. So that's what I'll be watching for on the monthlies. And I think you guys already know my targets, about 300 and then about this uptrend line and about 264. I laid those targets out on the weekly chart really way back here. T1, which we hit a while ago, a month and a half, 2 months ago. T2 coming up next at about 299, call it 300, round off. And then 268 right there for T3 and or the uptrend line. And then T4, at this point in time, my maximum target, if that's hit, is about comes in about 235 and that secondary or blue uptrend line. All right, so that's that. Today, let's talk about today. Nice drop, 3.86 down on the NASDAQ 100, QQQ, one of your bigger red candles. And so, look, last week, before we even headed into last week, I suspected that might be the week where we get that, what I call next big leg down, waterfall selling, a move towards my second target on the weekly chart. It started out that way, but like I said, whatever forces they were, there was a big stick save, and we had a rally. But again, it really didn't change anything in the longer term technicals. We're still below all the big moving averages. The 200-day moving averages are up here, both the simple and exponential way up there after several back tests and failures once we broke below it, both on SPY and QQQ. Everything else, nothing much else to add other than let's just get down to what I've been talking about here on the 60-minute chart. As I said, and I still suspect, we'll see, I think we've gotten close enough now. I think we'll just go on down from here. It's a micro call, but I think that's it. As I've been saying before, I thought if we do have to take out those lows, and there still may be positive divergence and the potential for a rally. Anything's possible. I'm not going to sit here and tell you what, the market must go down or could go up. I'm talking in probabilities, things that are more likely. And I think that we're at that point where, especially because now, and the reason I said in the last week or so, if we got back even close to those lows, I think we'll cut right on through there. This is just you try to read into the market, try to feel and understand where other traders are. It's like in a sense like the art of war. Know thine enemy, and I suspect that this is probably the last hurrah, or was, for the dip buyers that figured they were going to keep, like Pavlov's dogs, buying the dips, and it probably felt good. That was a healthy rally for them. Anyone that happened to buy it, or even if you just held on, let's say you were patting yourself on the back, and I'm just speaking generically for bulls, bears, because that's what the stock market's all about. It's trying to trying to use the charts to determine where the masses collectively will be buying and selling, and at which point trends change. So that was about it. That was a good 10% rally, and now the fact that we faded better than 2/3 of it tells me that that's probably, or could be, let's just say, could be the knife in the heart for the bulls, and so we could see some more selling here. There was that last, well, quite a few sell signals. We had one here on that breakdown on the 60-minute chart, objective short entry, plus that PPO sell signal I've been looking at for a little while here. PPO hitting this level, crossing above that plus 0.53 level, and then right after that, you extended the divergence, made another perfect, near perfect tag of the trend line. Boom, 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 and nice rejection. So if you took either of those two short trades, just that alone, you're good for about a 7% drop just in the last couple days. So congrats to you. And that's where we're at. So we'll see what happens tomorrow this week. I'm very eager to see. And again, my expectations are it is probably going to be a quick ride down. Those bear flags that I told you have not been invalidated. We had that one green candle in between, and I'm talking about the bear flags on the weekly chart, and that would be from this point here. You had an impulsive leg down followed by pretty much a textbook bear flag, and also I really like the fact it came right back to those 40-week moving average, which are the 200 days, capped it as resistance. So, from a TA, technical analysis point of view, so far this couldn't be playing out any better. I wasn't crazy about the 10% rally, but as I commented on it, as long as we continued, didn't keep building up on that and have another green candle, just like you had one green candle in the flagpole on the way down, you have one green candle so far on the downside break of the pattern. So there it is, flag, pattern, measured target. Again, I've gone over, should take us close to, should project down to around my second target there at about 299.15, where I would put the odds pretty good on a reaction, even if it's a brief intraday overshoot, probably consolidate around there. Although anything's possible, the crash warnings, kind of put out on the market a couple months back are still in play. They're still in existence. And what I mean by that, it just the odds for the potential for a crash are elevated. And you can't say that at every point in time. There's always anything's possible, a black swan event. But as far as probable, everything I've covered, put to call ratio, sentiment's still low. They're still not. I've covered this, and I'm not going to do it in this video. The put to call ratio, and showed you that we're not even close to where previous corrections, even smaller corrections, have ended with a spike in the put to call ratio. So even the VIX, VIX is still not really exploded yet. Here's the weekly chart. There's the daily chart. The VIX is just above where it was back here on the 24th when we had that first low down and we hit my first target there. And so we're back there again, and it just shows me that there's not enough fear in this market, which opens the door for a much bigger drop. And why does that? How does that work, Randy? Why is fear? Well, the more fear in the market, and again, the VIX is calculated using options, put calls, and so comparable or similar to the put to call ratio is just showing, collectively the masses believe that, like every other time for the last few years, including COVID when things hit, Uncle Powell's going to come and save the day, print more money, pull out some rabbit out of his hat, maybe Biden too, the administration. So we'll see. I don't think so this time around, but anything is possible. And so the takeaway is, if you are profitable on your shorts, especially with all these entries we've had for months now, even starting way back up here, there's no reason at all to turn this thing into anything remotely close to a loser. I will let you know if and when things change. Again, I've talked about levels that really would be of concern to me, and right now, let's just say the 200-day moving averages. Anything that takes us up to them again is just another test, and I showed you that before on the early in the video. Bounce backs to the 200 days once they're taken out, especially on a weekly basis. That's why you can use a 40-period moving average on a weekly chart. It's the same thing. Those are objective shorting ops. But again, my most likely scenario is now this is the week that we probably have a big slide down, hit those next targets on SPY and QQQ, and of course IWM. So that those remain my preferred indexes, pushing those shorts pretty heavy. And this is IWM, just a beautiful. I mean, this one's been great. We had a big sell signal there. To me, a major sell signal in that trading range. 1 year long was broken, 208.48, and then I highlighted right here. That was a beautiful objective. If you missed the first drop, you were given a gift right there. Another objective shorting entry, and we came down. We have a second. We tested that. That 191.10 was support, first target. I called this is technically my first target. When QQQ and SPY hit my first targets on the weekly, I threw this one in there as we came up to it and said that would probably be the first support level we bounced. We did. Now look, we checked it twice and here we are. So this is it. If we can push a little bit further, we're going to take out those lows, and there's no support above that. Anything is possible. We'll still have some divergence, but you know what? Divergence, as I said, in a downtrend, especially bear market, positive divergences will form, and then they often get burned through. Or maybe we'll look and see if we get to 170. I think we'll probably bounce off that level, have a tradable bounce, and we'll see if there's any divergence there, and other things that'll indicate if we're going to get a bounce or how likely it is. And then, of course, more importantly, how far, how do you trade it? Is it a quick trade, 1, 2, 3 day bounce trade? Is it a multi-week trade? Is it the end if we even get there? But right now I see zero evidence that the correction is over, and so I'm not looking to position, cover all shorts and go long for trend trades at this point in time. If that changes, I promise you will be the first to know. All right, let's look at well, yeah, let's just go down to the futures for you real quick for futures traders. Coordinating my futures trades. If you're an NQ or RTY, the small cap ETF, or even the minis, if you don't, NQ might be a little bit too big a contract for your taste. You can put an M in front of it, type in the symbol MNQ. If you trade futures, you should already know this. I don't recommend futures to people that aren't, experienced in trading and know futures, but it's just the micro contract or mini, whatever they call it, and it's, I think, a tenth of the leverage factor. Trades on the same exact price levels. So you can use this chart, replicate it, and again, it trades the same price levels, just has a smaller leverage factor. So that's that. And then on RTY, you can trade the M2K as your mini. Same thing, trades just a smaller leverage factor there. And again, I'll look to cover those. I'll be watching the futures themselves, and I'll be watching QQQ and SPY and IWM and all those, and we'll see where we're at. One more thing I wanted to update is somebody asked about gold. I said, Randy, I'm like to get into gold, either add or get in to begin with. What do you suggest? Buy the dips. Yeah, it broke out, and just like the stock market is in a downtrend, and I've been suggesting to just simply sell the rips. Remember, a downtrend, it's not a nasty, ugly thing. It's just an uptrend in reverse. Turn upside down. When you're in an uptrend, you buy the dips. Now, it's not so easy to just say buy the dip. I mean, technically, it does work. If you're in a bull market, you could have the worst timing in the world. You could be buying all the rips and you still get bailed out. And that's one of my favorite quotes in the market. It's not mine. I didn't come up with it. It's been around for years. It is never confuse genius on your part with a bull market, because you get bailed out. Likewise, if you catch a downtrend, you don't have to have your timing perfect. Obviously, that's what I work to do. Work very hard at that. Like, this morning and every other time we've had shorting ops. I'll point out where objective shorting ops are. But where I'm going with as far as sell the rips, like this morning, that's when we were, which chart was I using this morning? Oh yeah, it was this one, 60-minute chart. We had the pre-market trades here this morning. We were right up here. So, and that was a bounce back, and I showed you we had some of the futures were at resistance, and there was, I made the case to short this morning, and you were good for about a 4% drop. That's one of the biggest one-day drops that we've seen in quite a while. And so that's what I'm talking about is obviously by shorting the rips, if you can short rips back into resistance, all the better than just a random rip. And then going back to gold, yeah, on gold, it's in buy the dip mode. It broke out. Where would be the most objective level? It's almost going parabolic. It's not quite parabolic, but it's in a very strong uptrend right now. Maybe this trend line right here, start a trend line off the lows. That candle I just hit was from February 3rd. Maybe a pullback to there. It's hard to say. It's just not just, I don't have clear levels. The breakout occurred here on the break above the that symmetrical triangle I'd been highlighting for a while. That was the big breakout. You see it better on the weekly chart, and that was it. And if you weren't in gold already, a case was to be made for that. It was favoring upside break, but you had an opportunity there on the breakout candle. And then again, when we took out that 173.87 resistance, and it hasn't looked back. It's coming up towards the old highs, but we've had enough. Here's my thoughts. We've had enough consolidation. It's been about over a year of consolidation in a bull market consolidation, a big symmetrical triangle pattern, that there could be enough energy to just keep us going. It's not going to go straight up forever. There's going to be corrections, but as of now, I don't see anything in the chart really to say a correction's like it. We don't have divergence here on the 60-minute chart of GLD. We don't have negative divergence on the daily chart. We don't have it on the weekly. That's what a good old-fashioned consolidation will do in a bull market. It's healthy. What's not healthy is when things go up too fast, too far, like Bitcoin and other things like that, and then they come crashing down. So gold had a healthy consolidation, and again, I view that as a energy like a coiled spring, and that spring's been released now, and that old high it's not well defined. It's pretty much right about resistance right there, because after we peaked, we consolidated and were rejected around that 186 level. But again, like I said, buy the dips, and if there is an objective level, maybe we get a big knockdown in gold. Maybe it comes all the way back and back tests the triangle or that 174-ish level. That might be, and most likely would be, an objective entry. It again depends on what I see at the time. But I don't think we're going to get there. It's possible, and if we do, I'll talk about it at the time, or if I see any other objective levels to enter. On that, before I get away from it, and I still like silver as well, very much. Silver broke out as well. It's at pretty decent resistance now. This is SLV weekly chart, about 2383. You can see that line there. It was support, then resistance. We've had quite a few reactions, but whether we have a reaction here or not, I think silver is going to go up, also make a run at those old highs around 27. And so the same thing holds true on silver. Buy the dip mode. And then the thing I wanted to bring up, and I made this comment to or this reply to that comment in one of the previous posts from today that I made. Somebody asked about gold, is that the metals, they broke out as well. The miners are going to follow the metal. I mean, that's the biggest boon to their bottom line. But there's a couple other variables to consider here with the metals and the miners, that is. Particularly the miners. What I said is I like right now, more than usual. In a regular market, in a bull market, I'll be overweighted and sometimes only trade the miners, because I always say the miners are simply a leveraged trade on gold. When gold goes up X, they go up X times whatever multiple, and it's not a set multiple, but they go up more, and when gold's dropping, they drop more. So right now I'm bullish on gold, so to be bullish on gold is to be bullish on the miners, yeah, but two things here. Number one is they are stocks, equities. Gold's not an equity, it's a commodity. And as stocks, if we get a big meltdown in the market, and I've seen it before, I've seen periods like back in 2008 when markets were melting down, when stocks are falling hard, things are being liquidated, and the miners are going down or maybe not up as much as gold, because again, they are stocks. They get in their index, they're in mutual funds, they're in people's holdings. You're going to get margin calls. We have a huge debt bubble, margin bubble created by the Fed. Everyone gaming the stock market on leverage in recent years, and that's mostly long side traders. So there is that thing. Right now they're doing well. We're not in full-blown meltdown mode. We just had another bad day today. It's not what I'd call a crash or a meltdown in the market. So there's that. Just keep that in mind, and that therefore you might not want to be only in the gold mining stocks. And if you do start to see, waterfall selling, you see circuit breakers kicking into the market, then you might want to shift some of that money out of GDX or individual mining stocks or the silver miners and more into the metals if that's your thing. And as always, keep a balanced portfolio. There's pieces of pie. You can have whatever your pie is. Right now, I'm focused mainly. I have peripheral positions, obviously, but mainly it's not to scale. Stock market shorts on the indexes, primarily the Qs and small caps, Russell 2000, and then my short the markets, long precious metals. Been that way for a while now, and that's what it looks like. The other component here, which is it can come into play. You may, if you were here in the site back here, I made a very strong bullish case for gold back here because we had seen fuel prices dropping, the charts were strong. This is the miners. A couple points in time I've done this. Is crude oil. People don't think about this, but gold doesn't. This isn't 1849 anymore. You can't just grab a pan and jump in a creek over there in Sacramento or wherever, and find big gold chunks floating on top of the creek. That all the surface gold's been long since found. To find gold, you're digging deeper and deeper, and that takes heavy machinery and equipment, and then you sift the dirt and all that. It's energy intensive, okay, and so with oil going nearly parabolic now, no end to sight in that. That is likely, or will to an extent put pressure on the miners. It's all, yeah, the rising price of gold and silver is a boon to their bottom line, but then again, they're incurring additional expenses because we're in an inflationary environment. That means their labor, their employees are going to want raises because everyone else is getting them, and they're going to have to, pay for the fuel, the diesel and gasoline to run their equipment, machines, electricity. So therefore that could at some point, and probably will, especially if energy prices keep going up, take its toll on the miners. So and at least if nothing else, if gold continues to move up strong, silver, that should be a boon to them. It just may slow their roll a little bit, if you follow me. All right, so that's it. Let's just keep it limited to that kind of stuff. I'm not talking about the other metals because, like I said, I talked about this earlier today. Things that are very highly correlated, independent on Russia and or Ukraine, such as palladium, Russia being one of the largest, I think second largest last year, up there, palladium producer. So wheat, Ukraine being a big wheat exporter. Those are things that are just too subject to the news and the headlines right now. So they're running up with the other metals, with gold and silver, but platinum has a much more stronger industrial use. The single largest use of platinum is in emissions control for automobiles, and so. My thing. I look ahead and I'm trying to wind all these pieces, where I think a lot of other investors and traders in the market aren't seeing, and everything comes back to the stock market. If I continue to be right, we go down more. You're gonna and with crude running up, you're gonna hit. You're going to see demand destruction. This is a chart right here. I can't expand when I roll. It's not increasing the chart size. But this is from sources MUFG, Mitsubishi UFF Financial Group. And it shows what we're tracking. This is the red line is oil, Brent crude. 2001 to present, and so we're right here. We're going. This is this little parabolic run right now, and the gray line underneath it, it's overlaid to what happened leading up to the Great Recession, the bear market from 2007. Technically, the stock market peaked. I remember it well back in October of '07, but yet oil continued to ramp up, and then you have what they call demand destruction, where just the price of oil. The demand for oil just collapses under its own weight. Prices are too high. And now where I'm going with that, I know I'm all over the place, but if my price targets on the stock market are hit, It's going to take a huge chunk out of the wealth effect. Consumer spending and confidence going to continue to plummet. GDP goes down. Therefore, these car sales that are booming, you walk in the lot now, and some people are happy if they walked out paying sticker. In the past, sticker was where you negotiated down from, and in some cases, people are paying above sticker. And so again, that will see if all of a sudden auto sales start to slump, you're going to see the demand for platinum drop. Now, again, it's a wild card. If demand can drop, but if supply drops even more, prices can go up. That's the whole thing about it. Keeping an eye on what's going on over there. But that's that. Just want to share my thoughts. So for now, stay away. At least I'm staying away. And if I see an opportunity, I'll let you know. And same with crude oil. All right, now I was going to wrap up, but I'll just mention I threw out one other trade idea today after that short on the indexes, and that would be what was that, lumber. I'm trying to queue up the chart here. LB lumber, that was my hourly. I think I gave it to you on a 2-hour chart. Every candlestick's 2 hours. Why, if I'm bullish, on commodities and commodities are ripping, why be bearish on this? Well, first of all, it's simply just a setup on the chart. It's a setup, not an actionable trade. I made it very clear. I call a actionable trade exactly that. I will say it offered an objective short entry at blah, blah, blah point when it did this. This is a setup. It needs to break the trend line. I think it will. Wash, rinse, repeat. You got a bearish rising wedge with negative divergence, just like you had here, a bearish rising wedge, negative divergence, just like you had there, negative divergence, and that's where your corrections come from. But then to take it a step further, I'm not an expert in the lumber industry, but I think most of the lumber used here in the U.S. For home building, construction, other sorts, I think it comes from the U.S. and Canada, so I don't see any major supply chain disruptions there, or any embargoes or other restrictions being put on. And more so, I think the housing market, if I'm right on the stock market and we're going to go down quite a bit more, you're going to see orders for homes being canceled. You're going to see existing home prices. You're going to see interest rates going up. Powell, in my view, is almost criminally neglect in how dovish he's being, how slow he is to react. And the fact that he could come out last week, and say that, yeah, okay, we're going to raise, but only a quarter point. He's going to vote. To say that with what's going on with the price of crude, with the price of wheat, and all commodities exploding now, and it's not just a new recent trend. To say that, and not even just say, okay, we'll probably hike, we'll adjust as necessary, leave it vague like he was doing, and that would have left the door open for a 50 basis point hike. So I don't know. I don't know if the other members can override him on that, or if he's going to change his tune. But again, you can see what crude's doing. And so, therefore, look, whether he does it he's clearly behind the curve, and so let's assume we're only going to get a quarter point now. There's going to be followed with additional hikes, and if things get worse, the Fed will be forced to do an intermediate rate hike to cool things down, or this inflation is just going to crush the U.S. and global economy. And then when that happens, demand for houses goes down. I'm watching ITB, the home builders ETF, and XHB. Those are the two home builder ETFs. I know what's going on in the housing market. You can see the market's going to tell you. You see the home builders dropping, interest rates are going up, and that's just not good for the housing market. And therefore, the supply I'm talking now fundamentals. The demand for lumber should go down. And either way, it's a setup. It either pans out or not. Maybe we keep walking up that trend line. Maybe it breaks down, recovers the trend line. If it does, you stop out. It shouldn't have a solid recovery back above the trend line if you get a breakdown. You can allow for a back test of the wedge, but nothing much more than that. And that is it. We'll wrap it up there. Get the video out to you guys, and we'll pick it up tomorrow. It'll be interesting to see what the futures do tonight. Don't always read too much into that unless, it's a huge move or some big level gets taken out technically. Important thing is how we close the day tomorrow and this week. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.